hitting new highs, leading to new highs, leading to new highs, leading to new highs means markets never correct, which doesn't quite make sense because markets do. But the idea of complacent investors showed up in a survey we just completed with our clients, published over the weekend, and they seem pretty comfortable with earnings outlooks, with a number of things, except for they think there'll be stickier inflation. 46% of them told us they thought there'd be 9 to 12 months of inflation versus 32% saying transitory 3 to 6 months. They're worried about the Fed raising rates in the second half, a majority of them, of next year, as opposed to waiting to 23. And, if we look to our credit strategy team, they're looking at peak QE. And historically, that's also meant some problems in the market. I really think, to answer it very quickly, Wilfred, is that there are 4 things that could coalesce around August and September timeframes, including taxation, tapering, maybe some more inflation concerns, and then lastly, margin pressures.
So on top of that, how do you feel like your clients are positioned coming into this period, having carried out that survey and those conversations?
So we think they are positioned long in the market, but there has been a slight uptick of concern. So, for example, what we've seen is they've raised their cash a little bit. Median cash positions have gone to 4% as a percent of assets under management, up from 3% in March. They've shifted a little in terms of their preferences for the year. They think energy will continue to do really well. They think utilities will continue to do poorly. And even tech is losing some of its, if you like, adherence. Now, I would say one other thing that was pretty obvious there. They like Europe more than they like the U.S., which is kind of interesting. And they still like commodities. So I do believe there's still a value trade coming. Yes, commodities have backed off, but labor costs could be your next area for inflationary pressure.
So your recommendations out of this, Tobias, you like value, even though you're cautious on the overall market?
So, Sarah, what we do is we like value right now. We think later this year, there'll be a push back to growth because some of the pressures of inflation, let me give you one example. About 2% of the workforce is currently out of the workforce because they don't have access to simply the ability to get daycare or kids back in school. And they will probably start to come back September, October, November. So some of those labor cost pressures should ease later this year. But in the meantime, it's still a phenomenon. So I do think there's an opportunity for growth later this year into 2022. I almost view, if you think of the last decade or so, you've had growth outperforming value tremendously. So investors are conditioned to buy growth. And as a result, one of the things I worry about is the idea that value is kind of a dalliance. It's a fling, and then they go back to their true love, growth.
Shepard Smith here. Thanks for watching CNBC on YouTube.